Today we're going to be taking a look at an investment portfolio. This one happens to be my wife's Simple IRA that she has through her employer. So I don't manage this for myself. This is done through her employer's Simple IRA, so it's done by a large household name firm. I'm not going to mention it here, but just know that if I said the name, you would probably recognize it right off the bat. So in today's video, we're going to do a deep dive of how do we analyze a portfolio to see, is it good a portfolio, is it bad? What things do we need to consider when looking at it? So let's dive right in. I've got a portfolio checklist here. I'll drop a link in where you guys can actually go in and download the checklist for yourself, so you can do this on your own when reviewing your own personal portfolios. So first thing we want to look at anytime we look at a portfolio is the intent behind it. What is the purpose? Are we trying to drive income from this portfolio? Is it a growth portfolio? Is it a hybrid? So in this case, my wife's young, where she's in her 30s. This is a growth portfolio. In fact, when the advisor met with her to see how do you want the account set up, she said 100% aggressive. Put me all equity. We want max growth possible. Next thing I'll look at here is time horizon. Again, she's young, so we got a long time horizon. So the aggressive portfolio nature suits it here. Next, we're looking at withdrawal needs. She's young, withdrawals doesn't matter for this particular type of portfolio. This is a Simple IRA, so it's all pre-tax. So we have tax advantages here. So we don't have to worry about short-term capital gains or anything like that. So this is pretty straightforward. Same time you're dealing with retirement accounts from a tax standpoint, it's as far as like the money management part goes, the trading inside of it, you're not dealing with any type of capital gains or losses or anything like that. So it makes management a little bit easier from that point. All right, now let's dive into this portfolio. So the first thing we have to look at is the allocation. How is it invested? So in this case, we said aggressive. It's 95% stock, about 4% cash, like money market or so. Now, if you want to dive a little bit deeper into that, we want to see how much is invested around the world. So this portfolio is 78% North America, and then we got a little bit spread around the world. So it's predominantly US-based companies. And then we go look at the stocks sector. We can see that the majority of the holdings in here are large cap, so they're larger companies, and we have a few down in the middle, it's small cap sector. What I'm looking at here, and the reason I'm looking at it is just seeing where are we invested in. This all has to do with risk and diversification purposes. Are we all large? Do we have some small? So in this case, you have a bit of mix of a little bit of everything going on in here. All right, next we're going to slide over to our sectors. This is probably more important than the other two. It's really just seeing of the things we hold, what sector of the industry are they in? So in this case, this portfolio is about 20% tech. So almost a whole third of it is on one sector. You're banking a lot of money inside this one region here. And then we have another bigger stake in healthcare, financial services is probably number 3 or so. Majority of the portfolio is sitting inside this tech sector here. The reason why that matters is should this sector of the industry be affected by any point, it's going to pull down the portfolio a bit quicker. Now, next thing I'll look at is diversification for it. Let me pull down this tab here. You can see these are the different mutual funds that she's currently in. It says 8 positions. One counts as cash, but cash is 0. So it's really 7 tickers that this advisor chose to use here. So we have 7 tickers. Now, a lot of people look at these things and don't really know what they hold. So you got to see, what is invested inside them. So remember, every ticker holds hundreds, if not thousands of stocks inside of them. So now we go over to the holdings tab here. Now you see a list of all different stocks that are actually held within here. Now I have it sorted. We're sorted by portfolio concentration. So overall, about 3% of the portfolio is sitting inside of Microsoft stock. So even though it doesn't say Microsoft stock up here, because these companies actually hold Microsoft stock, you get exposure to them. Whereas this overlap, it means that 3 funds, these funds in particular, have Microsoft stock inside of them. And this DGYGX one, about 9% of the portfolio is Microsoft. So they're pretty heavy in Microsoft stock. Now, if you look at overlap in general, we don't have too much overlap. Maybe the top 20 holdings or so have some overlap. The main thing I'm looking at here is concentration. So we have 3% Microsoft, 2% Apple, Amazon, Google, Netflix, and so on. So the top 4 here are more tech-focused companies. That kind of matches up to what we saw earlier with the majority of the portfolio being in the tech sector. Next one we like to look at here is the risk side of it. So on a score of 1 to 100, where does it stand? It's currently at a 67. It's about 2/3. So you could say it's more of a moderate portfolio in terms of risk. So the problem with this is when she asked to be put into 100% stock or equities, we want the risk to be higher because we were trying to increase our returns here. The fact that the risk is only 67 says that we're not actually being invested inside equities the way we want to, or maybe the equities we have lower performing funds. They're not really giving us a true exposure from them. We're accepting a little bit less risk here. And in this case, we probably wanted more risk because we wanted to enhance the performance. So that's just one thing to keep in mind for that risk corridor. So that might not line up with what the intention of the portfolio was. Now we look at correlations. Correlations just say, of all the funds we have, we want to make sure that they're moving independent of each other. So right now it's saying, you see this first one here is comparing this BMGKX to itself 1. That means it's moving 1 for 1. Now, how does this one compare to here? It's currently 0.12, which means they're not correlated at all. So the reason why you don't want things correlated is if one stock drops, you don't want the other one to drop at the same rate. Or if something in one sector hits, you don't all to follow the same path. So on here, it actually highlights in red the ones that are more highly correlated. Anything over 0.9 you consider basically the same. 0.8 is caution flag. So on this one, this 0.85, this Dodge GX and GSXX is 0.85. You can see the history. So that means is those funds are basically doing the same job. So that gives us a sign that maybe we don't need both those funds in this portfolio. If they're going to do or move in the same direction, we can maybe move that capital into a different direction that is less correlated, and that would reduce the risk in the portfolio or could even enhance returns. So that's where correlations matter when looking at things. You don't want everything so correlated that you could have, 10 different fund selections, but if they all move in the same direction, you're not diversified. That's why we look at these correlations. On the stress test factor here, it's just looking at past crises to see how exposed it is. So this portfolio, it's saying during tech bubble, it's down 10% and so on and so forth. I don't pay too much attention to this. It's just saying, should this happen again? That's where you're exposed to, or what your losses would have been. Now let's flip over to the performance sector. We're going to look at the risk experience. So my favorite ways to do this is on this plot chart. So what this is showing is the risk versus return for every fund plus the portfolio as a whole. So on this bottom here, we have volatility or standard deviation. So the further to the right we go, the more volatile it is, which means it's more risky. That stock is going to swing one way or the other, either up or down more, right? So how bigger swings. On this other axis here, we have our returns. So the best investment you can get is something that's low risk, high return. And if the more risk we take on, we should see our returns go up as well. Like you can see in this portfolio, it's really not the case. The portfolio averages, or at least this last year, our return of 6%, taking on 10% volatility. So the portfolio swings, has basically a 10% swing up or down over that year. On average, it was positive 6% this past year. Now we can see down here, this is the cash sector. Makes sense, no risk, which is why we have a little return on it. This is the one that kind of bothers us. We're taking on this volatility risk, right, 21%, and it was a negative return. So I took all that risk and got nothing. I lost money on it. So that's really not playing out. Next and over here, kind of same thing. We took on this big degree of risk and we only made a little bit of money. So in other words, the risk wasn't really worth the return here. Same thing with this one. It's not performing as well as it should. If we were taking on this low risk, we'd probably want to be a little bit higher in here. Now this outlier up here is your best performing one. It returned a lot more than the risk that it took. So if I was looking to like move funds around, I would be looking closer at these three over here to see, is there something that we could replace it with? This one I might keep. Now it's only 1 year time horizon. It's always important to look over longer time periods and not just judge something over 1 year. So we go back over 3 years, we can see how everything shifted up and to the right. And that's more or less what you want to see when looking at portfolios. So now the funds that had those higher risk ones, I believe it was this BMG one, we can see that BMG volatility was about the same, but the return was better over the last 3 years. So it may just had a bad year. But given the fact that it's all the way out here and it's returning less than these other sectors or stocks that have less risk, that'd still be on my radar to look at. And then we want to go back 5 years. And the reason I want to look at 5 years is the last time we had a dip in the market was 2022. So it's important not to just cherry pick the good years, the growth years. You want to look at the whole thing or the last cycle to see how it was. So you see how everything came back down when I hit 5 years. So this portfolio probably didn't have a very good 2022. So 5 year return, see this one is negative and it has a little bit higher volatility going on in it. Now, if we look at the return in general, we can see that it went from a high of 21%, went down to 18%, and it took a while to recover. So it's important to look at this in general. So we're going to highlight the drawdown periods, the risk you're taking on here. So maximum drawdown was 33%. So what that means is from peak to bottom of the last market correction, this portfolio lost 33% of its value. So to put that in perspective, it went from 121,000 to about 81,000 or so. All right, so it's a $50,000 swing in less than a year. So what this is saying is from November 8th, 21 till October 14th is when it bottomed. We had 340 days where the market went down, or we weren't at all-time highs. That's really what that means. And then it took until August of 24 before we came back to even. So it was 686 days from the last time we got a high to we got our money back. All right, so it's quite a bit of time to get in here. This is why when you have aggressive portfolio, portfolios and you can afford to wait out the market cycles, this isn't a big deal. If you're going to retirement in the next, 2, 3, 4 years, this might hurt you because you might lose the money and it might take a few years to get it back. And if you need it for income, that's a little bit of a problem. So that's why we always start looking at the intention behind the portfolio before diving into this. So next thing we want to look at is the status report of it. Basically, there's a lot of numbers here, but I only look for a couple of things. Over the last 5 years, this portfolio did 33% return, which is about 5% per year, 5.9. It had a standard deviation of 15%. So that's the swing or the risk factor you're taking on. It had a Sharpe of 0.22, a Sorrento of 0.36. Sharpe, well, all we're trying to look at here is looking at the volatility that you took on inside the portfolio and to see if the risk you took was worth the reward. So with Sharpe, anything close to 1 is a very good. So when looking at Sharpe ratios, anything close to a 1 tells you that for every degree of risk we took, we got compensated the same amount of return. So if I'm going to take X degree of risk, I expect X degree return, and that matches. Anything less than 1 means that we're undercompensated, that the portfolio didn't generate as much returns given the level of risk we take on. So a 0.2 means this portfolio is underperforming, that for all the risk we're taking on, it's not hitting our goal. The next one we look at here, the Sortino ratio, this one only looks at the bad risk. So Sharpe ratio looks at risk in general. It considers good risk and bad risk. So anything that goes up a lot, it considers that risk. You and me would be like, that's not risky for growing. Sharpe ratio takes that into account and kind of swing. Sorrentino is more for like us. It's when we are losing money, how much do we lose kind of thing. So it only looks at the bad risk we're taking on, and same thing. If we're trying to shoot for a 1, ideally, anything greater than 1 means the portfolio is doing great. 1 is kind of your target, or you want to be as close to 1 as possible. If we're getting less than 1, it means that we're not being compensated well for the bad risk that we're taking on. Bad risk meaning the risk that actually goes down. So when the market does swing down, are we being compensated when it does turn around in terms of positive returns? In this case, it's saying not really. 0.3 out of 1, that's a feeling great. So last 5 years, this portfolio isn't looking so hot. Now, when you move the needle, let's go 3 years, you can see everything shifts around a bit. And we have 1 year. Overall, it's not looking the best just from this standpoint. The question we're trying to answer here is, was the downside risk worth it? In this case, it doesn't really look like it. Now, if we go back to the return screen here, we'll move this out of the way. In order to see is this doing well or not? You can't look at it in a vacuum, because if I looked at this and said, hey, you're up 33% in 5 years, it's like, good, I made money, but is it good? Is it not good? It's really hard to tell. So that's why we have things called benchmarks. So when picking a benchmark, what's something that's going to line up in terms of risk to it. So I chose this one here, which is a 90-10 portfolio. So when we go here, we'll see that this portfolio we're looking at that is 95.5. The one I picked to emulate is 90% stock, 10% bond. So it's probably more conservative. So if I look at it on the risk score here, you can see that tick down to 63. So it's slightly less risky than what we're taking on. So when we're looking at this, if we're taking less risk, we should expect less return. And if it's not the case, that means that we're taking on too much risk in the current portfolio. So let's go back to the performance tab, and you can see how that story plays out. Green line being the current portfolio, blue being the index. Now, if you're wondering what are we investing in here, this is just SPY, 90% to represent SP 500, AGG to represent the general bond market. So over the last 5 years, we can see that they kind of mirror each other, that the drops and the angles and the movement patterns are essentially mirror images of it. But you can see that really what separates it here, it's close here, but it's when it's going down, the index or our benchmark here doesn't go down as fast. It's taking on less risk or less bad risk from it. And you can see that that separates the portfolio. That way, when the market returns, this one has to make up for a negative 18% loss. This one only has to make up for a 2% loss. So it's a lot easier to bounce back from a 2% and 18%. And that's how this margin gets wider. And over the last 5 years, a 33% looks abysmal compared to 88%. That's why it's important to look at benchmarks and compare it to see if the portfolio's meeting well. Now, if we cut out the last 5 years, which cuts out the down market, just see, hey, when the market's positive, are they doing the same thing? And still not really it. So if we basically started the same on January 29th of 2023, that is exactly 3 years ago from recording this video here, you can see that even here we have a little bit of a discrepancy, and over time that slowly gets wider and wider, and we had that little bit of a correction beginning of 2025. This one isn't losing as much. It went from a high of 49 total return down to 26, where this one went from 35 down to 11. So all in all, what this is telling us here is that this benchmark is less risk, is performing better. Maybe we might need to make some corrections to this portfolio. Now, the next thing we want to look at is just the fee drag on it all. So we want to see what is the cost of portfolio. So for the fees on here, the advisor and the firm charge about 1.36% AUM on it per year, which of course drags down the performance. This index fund isn't being dragged down by it, so you don't have the fee drag in here. Of course, if you had an advisor do this for you, then you would. This is showing, what the return is with fees, which is I think a lot of people miss out when they run things on their own. It's not accounting for that fee. Next, you look at, what is the actual fund cost inside of here? So on this portfolio, that's roughly $18,000. It costs another $121 in internal expenses. So all these funds listed up here each have their own fee. So this one charges 0.98%. It's charging almost a full 1% just the fund alone. No investment advisor, nothing, just to be in that fund. So that's pretty high. I see most of these funds are pretty darn high. Even this one not here. Consider you can go to Vanguard and get something for a fraction of the cost. So I'm quite surprised that the company's even with these guys, just because looking at the price for the funds and stuff, this doesn't look like it's compliant or in lines with ERISA. And they're basically overpaying for these funds. Plus you're getting hit with that other larger advisory fee on it. I manage employer plans, and the all-in fees we try to keep them less than 1% all in. The advisory fee, internal expenses, all that, we're like way under 1%. And here you can see how these guys really don't care. It's one important thing not to overlook inside of your employer-sponsored plans. Next thing I'll usually look at is like tax efficiency. This is a retirement account. There's no need to get into that, so I'll skip that section. Now let's go ahead and take a look at the performance history just to see, from an emotional standpoint, is this something that we could realistically hold on to during the last cycle? So if I go here to the last 5 years, back off on the benchmark here, I like looking at this from a dollar standpoint, just to kind of see. So 5 years ago, if we had $100,000 starting off this portfolio, you see what it went to 116, and then we come back down, you can see about $78,000. So it's almost a $50,000 swing in the negative direction. Is that too much for someone to stomach? Now in this case, I was young, so that's kind of what we signed up for. If this was someone getting close to retirement, that type of negative downswing might not be something to stomach. So that's an important thing to look at, is can a real person actually stomach the amount of risk that the portfolio is giving you? Now overall, what works in this portfolio is it does grow. Anytime the market goes up, as long as you have most of the right picks, you're going to see some positive growth on here. So it is growing. However, it's not really doing what we expected. So if we look at the year of 2025, we knew that the S&P 500 did about 17% or so. And so this is just a straight up 100%, S&P 500 index for 2025. So 16, 3, 7.5. So if I'm looking at this and said, hey, I want to be aggressive, can you just give me S&P 500 and then that returns 16% and I get 7, that's less than half. So to me, this portfolio failed in terms of returns last year. And it was doing well up until something happened in July, where this portfolio just kind of went flat and it stopped really moving upwards when the S&P did. So this underperformance, even after fees, to me, that's just too much for someone to handle, or it's just you're taking too big of a loss here. So I would question what happened in here in this portfolio and why it's been sort of stagnant since July of last year. So if we want to zoom in a little bit on it, you can sort of see that this is, again, we're going back to our risk and return metrics. We have funds out here that have very little return, very high risk. A couple more along here too, where it's little return, but a little bit higher in the risk schedule on here. So those might have drugged the portfolio down overall. If I go back over the last 5 years, you see sort of is the same thing here, where this one's actually negative return with higher, to a high degree of risk. So if I were to change things, I would look into these type of funds that may be dragging the portfolio down, see if there's something else I could swap it with that might help enhance the portfolios further. Now, this is my wife's Simple IRA account. The nice thing with Simple IRAs is you can actually roll them over once per year. So that's exactly what we did. Is I actually did roll over last year. So we're no longer in this type of account or have any of these funds. I sold them all off and I put her into my own stock portfolio that we handpicked the stocks for them. It's the same as these for my clients and myself. I do have a video comparing this exact portfolio we looked at to that stock portfolio, so you can see what we went into, why we did it, and how it works overall. That video is inside the VIP part of our Washington Wealth Breakthrough group. The group is free to join. The VIP membership costs a little bit, but you get access to the full course and videos like this one that go deeper into portfolio comparisons. If you guys want to join that, the link will be in the description below. And until next time, remember that your future depends on what you do today.